especially in the United States, that the Fed at some point is going to lower the rates. The White House wanted it. They've been pressuring Jerome Powell to lower rates, and the street wanted it because it's the easy trade. And also, the street thought that at some point inflation is not going to be an issue anymore, and that rates will eventually go lower. And also, this view that rates will go lower was also the view of the bear side or the players who thought that economy could be in trouble and that the Fed and other central banks around the world will have to lower rates to boost the economy. So the result of this is that we had a continued inversion of the curve, at least in the United States and in a number of European countries, between the policy rate, so the Fed or the ECB funds, and the 2-year rate in these countries. So for example, United States, consistently, the 2-year US government yield traded under the federal funds rate. And that's not necessarily a normal situation. It basically translates, or what it tells you is there's an anticipation that the Fed was going to cut rates. So the market was a little bit ahead of itself. And what happened in Iran set the clock back to zero. So we had a massive sell-off in the short end of the curve, particularly, even though the long end also sold off, but much more on the shorter end of the curve. So we had a bear flattening. And now for the first time since 2023, the US curve is sort of back to normal.